Hello, and welcome to Smart Reads in Minutes, where we break down the most powerful books into bite-sized summaries. Today we're diving into The Psychology of Money by Morgan Housel, a book that reveals why financial success isn't just about intelligence or technical knowledge, but about behavior, emotions, and decision-making habits. It explores the psychological factors shaping our financial choices, how our experiences, biases, and perceptions of risk and luck influence our wealth. Mastering money, as Housel argues, isn't about complex formulas. It's about understanding ourselves. Let's get started. Introduction: The Greatest Show on Earth. The introduction immediately challenges the conventional notion that financial success is solely a product of intellect. Housel uses the anecdote of a wealthy tech executive who, despite his financial acumen, squandered his fortune through reckless spending and a complete disregard for long-term financial planning. This story serves as a powerful illustration of the book's central argument. Financial intelligence without behavioral intelligence is a path to financial ruin. Housel posits that finance, unlike fields like physics or engineering, is not governed by predictable laws and formulas. Instead, it's a field deeply intertwined with human psychology, making it inherently unpredictable and often irrational. This sets the stage for the book's exploration of the psychological drivers of financial success and failure. Chapter 1: No One's Crazy. The chapter delves into the idea that financial decisions, while they may appear irrational to outsiders, often make perfect sense to the individuals making them. Housel argues that no one is truly crazy when it comes to money. Instead, people's financial choices are shaped by their unique personal experiences, upbringing, and circumstances. Our views on money are not formed in a vacuum. They are deeply influenced by our lived realities. Someone who grew up during a financial crisis, for example, will likely have a significantly different risk tolerance than someone who experienced only economic prosperity. These formative experiences create distinct mental models that influence how we approach investing, spending, and saving. Housel emphasizes the subjective nature of financial behavior. Even individuals with the same level of financial knowledge can make drastically different choices based on their personal circumstances and psychological conditioning. Someone from a financially insecure background might prioritize saving above all else, while someone raised in affluence might view aggressive investing as the most logical path. The book also explores the impact of generational and economic differences on financial perspectives. Individuals who came of age during the Great Depression, for example, will likely have a different relationship with debt and risk than those who grew up in times of economic expansion. These generational experiences shape our attitudes towards money, security, and risk. Furthermore, Housel argues that markets are not driven solely by logic and data. They are also heavily influenced by human emotion. Fear, greed, optimism, and pessimism all play a significant role in shaping market behavior. Even professional investors, despite their expertise, are susceptible to psychological biases and past experiences that can lead to irrational decision-making. Housel encourages us to avoid judging others' financial choices without first understanding the context of their lives. He advocates for empathy and a more nuanced understanding of financial behavior, recognizing that what seems crazy to one person might be perfectly reasonable to another. Chapter 2: Luck and Risk. The chapter examines the often blurry line between luck and risk in the context of financial success and failure. Housel argues that we tend to underestimate the role of luck in our achievements and downplay the impact of risk in our setbacks. He suggests that recognizing this delicate balance is crucial for making sound financial and life decisions. Housel points out that success is not always a direct result of skill and hard work. Sometimes, it's simply a matter of being in the right place at the right time. He uses the example of Bill Gates, whose early access to computers in high school, a rare opportunity in the 1960s, played a crucial role in his later success. While Gates's talent and hard work are undeniable, his fortunate circumstances also contributed significantly to his achievements. Conversely, Housel argues that failure is not always a consequence of poor choices. Sometimes it's simply a matter of bad luck or being on the receiving end of unforeseen risks. He emphasizes that many hardworking and talented individuals never achieve extraordinary wealth due to circumstances beyond their control, such as market crashes, economic downturns, or unexpected personal challenges. Housel cautions against the common tendency to overgeneralize success stories. He argues that society often idolizes successful individuals and tries to replicate their habits without fully acknowledging the often hidden role of luck. We should be wary of blindly copying the strategies of successful people, as their achievements may be attributable, at least in part, to factors that cannot be replicated. The chapter encourages us to cultivate humility in the face of success, recognizing the role of chance, and to practice forgiveness in the face of failure, acknowledging the impact of uncontrollable risks. Chapter 3. Never Enough. The chapter explores the dangers of insatiable greed and the destructive consequences of always wanting more, even when one already has enough. Housel warns that the inability to define enough can lead to financial ruin, deep regret, and unnecessary risk-taking. He illustrates this with the story of Rajat Gupta, a highly successful businessman who, despite his wealth and status, engaged in insider trading in an attempt to amass even more. Gupta's story serves as a cautionary tale, demonstrating how the relentless pursuit of more can lead to catastrophic consequences. Housel emphasizes the importance of defining enough as a cornerstone of long-term financial success. He argues that if we never establish clear boundaries for what constitutes enough, we will perpetually feel dissatisfied regardless of our material wealth. He suggests that many financial collapses occur because individuals fail to recognize when they have reached a point of sufficiency, constantly chasing ever larger gains. The chapter also highlights the often exorbitant costs associated with the pursuit of excessive wealth. Housel argues that the relentless chase for more can lead to the sacrifice of integrity, peace of mind, meaningful relationships, and even legal repercussions. He warns against the allure of high-risk financial ventures, emphasizing that those who take unnecessary risks in the pursuit of outsized returns often end up losing everything. Housel champions the importance of contentment as a key ingredient in true financial well-being. He suggests that genuine financial security comes not from having the most money, but from knowing what is enough for our individual needs and desires. He argues that the happiest people are not necessarily those with the greatest wealth, but rather those who have cultivated a sense of contentment with what they already have. This chapter serves as a powerful reminder that true wealth is not measured in dollars, but in the peace of mind that comes from knowing when we have enough. Chapter 4. Confounding Compounding. The chapter highlights the incredible power of compounding and explains why so many people fail to appreciate its long-term impact. Housel uses Warren Buffett as a prime example. Buffett's wealth isn't solely due to his investment genius, it's also a product of time. He started investing at a young age and has consistently stayed invested for decades, allowing the magic of compounding to work its wonders. Housel argues that if Buffett had started later or interrupted his investment journey, his wealth would be significantly smaller. The key takeaway is that time, not just skill, is a crucial ingredient in financial success. Compounding, however, is difficult for many to grasp. Small, consistent gains may seem insignificant in the short term, but over long periods, they grow exponentially. Most people tend to think linearly, expecting steady, predictable growth. Compounding, on the other hand, is exponential, meaning that small gains today contribute to even larger gains tomorrow, creating a snowball effect. This is why time is the most powerful factor in wealth building. The longer you allow your money to compound, the more substantial the results become. Many investors sabotage their own success by chasing quick wins, selling too early, or panicking during market downturns. They interrupt the compounding process and limit their long-term potential. Housel emphasizes that patience is the ultimate investment strategy. The best returns come not from hitting home runs, but from consistently achieving decent returns over decades. The key to financial success is to start early, stay invested, and let time do the heavy lifting. Wealth isn't built overnight, it's cultivated over time through consistent effort and the power of compounding. Chapter 5. Getting Wealthy versus Staying Wealthy. The chapter explores the distinct skills required for accumulating wealth and preserving it. Housel argues that these are two very different endeavors, requiring different mindsets and strategies. Many people are adept at making money, but struggle to keep it because they fail to understand the necessary shift in perspective. Getting wealthy often involves taking risks, embracing optimism, and making bold decisions. Entrepreneurs, investors, and business leaders often accumulate wealth by betting on opportunities, accepting uncertainty, and sometimes even getting lucky. However, the very mindset that drives wealth accumulation can also lead to reckless decisions that ultimately wipe it out. Staying wealthy, on the other hand, requires humility, a degree of caution, and a focus on risk management. It's about preserving what you've earned, not constantly chasing more. Many people lose their fortunes because they assume that what worked in the past will continue to work in the future. They become complacent and fail to adapt to changing circumstances. Housel stresses the importance of survival in investing. The best investors are not necessarily the ones who achieve the highest returns in a single year, but rather those who can survive market downturns and remain invested for decades. He argues that the most important rule of investing is to avoid taking risks that could lead to catastrophic losses. Long-term success in wealth building is not about maximizing returns, it's about avoiding ruin. Housel also emphasizes the importance of having a margin of safety. Smart investors plan for the unexpected by having extra savings, diversifying their investments, and keeping debt levels low. Unexpected events, such as market crashes, economic recessions, or personal emergencies, are inevitable. Those who have a financial cushion are better equipped to weather these storms and preserve their wealth. The key takeaway is to balance boldness with caution. To build wealth, calculated risks are often necessary. But to keep wealth, humility, patience, and a healthy dose of caution are essential. Chapter 6. Tails You Win. The chapter explores the significant impact of rare but powerful events on financial success. Housel argues that while many people focus on averages and trends, it's often these infrequent, extraordinary events that drive the most significant outcomes in business, investing, and life. He points out that most success comes from a few big wins, or tail events. In investing, for example, Warren Buffett's vast wealth is largely attributable to a small number of highly successful investments, even though he has owned hundreds of stocks over his lifetime. Similarly, a company's success often hinges on a few key products or innovations. Apple's iPhone, for instance, accounts for a significant portion of its profits, despite the company having launched numerous other products. Housel also notes that failure is common, even among successful investors and entrepreneurs. Many ventures fail, and many investments don't pan out. However, the key is that the few big wins more than compensate for all the losses. Venture capital firms, for example, expect most of the startups they invest in to fail, but the few that succeed, like Facebook or Uber, generate returns that dwarf the losses from the failed ventures. Housel emphasizes the importance of patience and resilience. Because success is not evenly distributed and relies on these rare, powerful events, it's crucial to stay in the game long enough to benefit from them. Investors need to be able to weather market downturns and learn from their mistakes to capitalize on the game-changing opportunities that arise. Chapter 7. Freedom. The chapter argues that the ultimate goal of financial success is not simply accumulating wealth, but achieving freedom and control over one's time. Housel suggests that true wealth is not measured in dollars, but in the ability to wake up and decide how to spend your day. He argues that most people mistakenly believe that wealth is about luxury, possessions, or power. However, the most valuable thing that money can buy is autonomy, the ability to control your schedule, to pursue your passions, and to spend time with loved ones is a rare privilege, and it's the true mark of financial success. Housel points out that studies have shown that people with little control over their work and time experience higher levels of stress and dissatisfaction, even if they earn a high salary. No amount of material wealth can compensate for a lack of autonomy. He also argues that small daily freedoms can bring more happiness than vast amounts of wealth. The ability to work on your own terms, to take a day off without worry, or to simply have unstructured time to pursue your interests can be more valuable than a luxurious lifestyle. Housel argues that the richest individuals often lack the one thing they need most: free time. If you have money but no freedom, you are still controlled by obligations and responsibilities. True wealth comes from having a low cost of living relative to your income. Financial freedom is not necessarily about being ultra-rich. It's about having low financial obligations so that you don't have to work out of necessity. Many people who earn high salaries find themselves trapped in jobs they dislike because they increase their spending as their income grows. They become slaves to their lifestyle and lose sight of the true meaning of wealth. Housel concludes that the ultimate goal of money is not status or luxury, but freedom. Financial independence means owning your time, choosing what to do, and reducing stress. True wealth is measured not just in dollars, but in the ability to live life on your own terms. Chapter 8: The Man in the Car Paradox. The chapter delves into a common misconception about wealth and status. Housel points out that many people believe that acquiring luxury possessions, such as expensive cars, watches, or houses, will garner admiration and respect from others. However, the reality is often quite different. While people might admire the objects themselves, they rarely admire the owner. Housel argues that this pursuit of external validation through material possessions is a trap. When someone buys an expensive car, for example, the typical reaction from onlookers is not, "That person must be incredibly successful." Instead, the thought is more likely to be, "I wish I had that car." The focus is on the object, not the individual. This chapter highlights the futility of trying to buy admiration with luxury goods. Status symbols rarely achieve their intended purpose. Instead of boosting admiration, they often simply fuel envy or a desire for the same possessions. Housel argues that true financial success is not about flaunting material goods. It's about achieving financial security, freedom, and having options. People who are genuinely wealthy often don't feel the need to display their wealth through conspicuous consumption. They understand that true wealth is what you don't see, not what you do. The desire for status can be a dangerous trap, leading to overspending, debt, and constant financial stress. The irony is that the very people individuals are trying to impress are often preoccupied with their own desires and rarely give much thought to the possessions of others. Housel concludes that trying to buy admiration with luxury goods is a losing game. True wealth is about living life on your own terms, not about impressing strangers. Chapter 9: Wealth is what you don't see. The chapter reinforces this idea, emphasizing that true wealth is not about what you own, but what you don't spend. Housel argues that many people confuse visible displays of wealth with actual financial success. We often assume that someone with a luxury car or designer clothes is wealthy, but this can be a deceptive illusion. In many cases, these individuals have spent a significant portion of their money to look rich, rather than actually achieving financial security. Housel stresses that real wealth is invisible. It's the money that hasn't been spent, the savings in your bank account, the investments you hold, and the financial cushion you have for emergencies or unexpected opportunities. True wealth is the foundation upon which financial freedom is built. Housel warns against the trap of spending to impress others. Many people go into debt to maintain an illusion of wealth, which actually makes them financially weaker. They prioritize appearances over substance, sacrificing long-term financial security for short-term gratification. The truly wealthy, on the other hand, understand that wealth is not about accumulating things. It's about achieving control over your time, choices, and future. It's about having the freedom to pursue your passions, to weather financial storms, and to live life on your own terms. Housel concludes that the next time you see someone with a luxury lifestyle, it's important to remember that wealth is not what you see, it's what you don't see. Financial freedom comes from saving and investing, not from spending to look rich. Chapter 10. Save Money. The chapter highlights the critical role of saving in building financial security and freedom. Housel argues that saving is one of the most powerful financial habits, not just for building wealth, but for creating flexibility and peace of mind. Unlike investing, which is subject to market fluctuations and external factors, saving is entirely within your control. It's a habit that allows you to build financial security regardless of economic conditions or market performance. Housel emphasizes that you don't need a specific reason to save. While saving for specific goals, such as a house or retirement, is important, having general savings provides a buffer against unexpected events and creates opportunities for the future. Savings provide flexibility and freedom. A high savings rate allows you to handle job loss, market downturns, or personal emergencies without panicking. It reduces financial stress and gives you greater control over how and when you work. Housel also challenges the common misconception that getting rich is solely about earning a high income. He argues that how much you keep is far more important than how much you make. Even high earners can end up broke if they spend excessively. He stresses that wealth comes from savings, not just income. Furthermore, Housel points out that keeping your expenses low makes saving easier. Living below your means allows you to save a larger percentage of your income, even if your income is not exceptionally high. Frugality, he argues, is a superpower that allows you to build wealth faster and achieve financial peace of mind. Housel concludes that saving money is one of the most reliable ways to build financial security and freedom. It's a habit that empowers you to take control of your financial future, regardless of external circumstances. By consistently living below your means, you ensure that you always have options, flexibility, and the ability to navigate whatever life throws your way. These chapters collectively emphasize that true wealth is not about outward appearances or the accumulation of material possessions. It's about financial security, freedom, and the ability to live life on your own terms, achieved through disciplined saving and a clear understanding of the difference between looking rich and being truly wealthy. Chapter 11. Reasonable greater than rational. The chapter challenges the traditional economic view that individuals always act rationally, optimizing every financial decision based on pure logic and data. Housel argues that this assumption ignores the fundamental role of human emotions, habits, and personal values in financial decision-making. While pure rationality might suggest a mathematically optimal approach, it often fails to account for the complexities of human nature. People are not purely logical beings. They are influenced by fear, joy, past experiences, and a variety of other emotional factors. Therefore, expecting purely rational behavior in financial matters is unrealistic. Housel advocates for a reasonable approach to personal finance, emphasizing that the best financial strategy is not necessarily the most mathematically efficient, but rather the one that an individual can consistently stick with over the long term. He uses the example of investing. Theoretically, putting all your money into the stock market might yield the highest potential returns. However, if the inherent volatility of the stock market causes you to panic and sell during downturns, then this rational strategy becomes unreasonable and ultimately counterproductive. A more reasonable approach might involve a diversified portfolio with a lower overall return, but one that you can maintain through market fluctuations, allowing you to benefit from long-term growth. Housel underscores that personal finance is, by definition, personal. Individuals have different financial goals, risk tolerances, and emotional triggers. What works for one person may not work for another. The best financial plan is the one that aligns with your individual mindset, circumstances, and values. Ultimately, consistent behavior matters more than theoretical optimization. A less optimal, but consistently followed investment strategy is far superior to an ideal strategy that is impossible to maintain due to emotional or psychological factors. Chapter 12. Surprise. The chapter delves into the inherent unpredictability of financial markets and the importance of accepting uncertainty. Housel argues that the biggest financial events in history, both positive and negative, are often surprises that few, if any, saw coming. Events like the Great Depression, the 2008 financial crisis, and even the rise of the Internet were not widely predicted beforehand. This highlights the limitations of relying too heavily on past data to predict the future. Major shifts and disruptions often emerge from nowhere, defying conventional wisdom and expert forecasts. Housel points out that even the most respected economists and investors are frequently blindsided by unforeseen events. The stock market, technology, and human behavior evolve in ways that no model can fully capture. The future is inherently uncertain, and attempting to predict it with precision is a fool's errand. This does not mean that we should avoid investing altogether. Rather, it means that we should approach investing with an understanding of and acceptance of uncertainty. Since surprises are inevitable, it's crucial to build a margin of safety into our financial plans. This might involve saving more than we think we need, diversifying our investments across different asset classes, and maintaining a healthy level of liquidity. These strategies help to absorb the shocks of unpredictable events and prevent small setbacks from turning into catastrophic losses. Housel emphasizes that the future will inevitably surprise us in new and unexpected ways. Every era brings its own unique financial and technological breakthroughs, and assuming that the future will simply be a continuation of the past is a dangerous assumption. The biggest opportunities and the greatest risks often arise from these unforeseen events. Therefore, adaptability, a willingness to learn, and a preparedness for change are essential for long-term financial success. Chapter 13. Room for Error. The chapter builds on this theme of uncertainty by emphasizing the critical role of a margin of safety in financial planning. Housel argues that since life and markets are unpredictable, having a financial buffer, whether in savings, investments, or budgeting, is crucial for navigating unexpected setbacks and preventing small mistakes from escalating into major crises. He stresses that even the most experienced investors and financial planners make mistakes. The key to long-term financial success is not about achieving perfect decision-making, but about having the resilience and flexibility to survive errors and market downturns. A margin of safety acts as a financial cushion, protecting you from the consequences of both your own mistakes and the unpredictable events that are beyond your control. Housel uses the analogy of bridge engineering to illustrate this point. Engineers don't build bridges to support only the expected weight. They incorporate a significant margin of safety to account for unexpected loads and stresses. Similarly, in investing and personal finance, it's crucial to assume the worst-case scenario and prepare for it accordingly. Housel suggests that saving money serves as a form of insurance against uncertainty. While many people save for specific goals, such as a down payment on a house or retirement, saving also provides a crucial defense against unforeseen events like job loss, medical emergencies, or economic recessions. The more unpredictable life is, the more valuable a substantial savings buffer becomes. Housel also applies this principle to investing. Instead of trying to perfectly time the market or predict which investments will perform best, he advocates for a more conservative and diversified approach. A margin of safety in investing means that you can afford to be wrong occasionally without being completely wiped out. It allows you to weather market fluctuations and stay invested for the long term, ultimately increasing your chances of achieving your financial goals. Housel emphasizes the importance of humility in financial decision-making. Overconfidence can lead to excessive risk-taking and a failure to prepare for the unexpected. Acknowledging that you don't know the future and building a margin of safety into your plans ensures that you can stay in the game long enough to succeed. Ultimately, financial success is not just about making the right moves. It's about avoiding catastrophic losses. By building a financial buffer, investing conservatively, and planning for uncertainty, you give yourself the flexibility to navigate life's inevitable surprises and achieve long-term financial well-being. Chapter 14, You'll Change. The chapter delves into the difficulty of predicting our future selves and the impact this has on long-term financial planning. Housel argues that we consistently underestimate how much our tastes, goals, and values will evolve over time. This phenomenon, known as the end of history illusion, leads us to believe that while our past selves are different from our present selves, our future selves will remain largely the same. This flawed assumption can have significant consequences for our financial decisions. Many people make long-term commitments based on short-term desires, locking themselves into financial and career paths that may no longer align with their evolving priorities. For example, someone might commit to a 30-year mortgage based on their current dream home, only to realize 10 years later that their lifestyle and preferences have shifted dramatically. Housel emphasizes that flexibility is far more valuable than precise long-term planning. Since we cannot accurately predict how our preferences will change, it's wiser to build financial flexibility into our plans. This might involve maintaining liquidity, avoiding extreme career specialization, and saving more than we currently anticipate needing. Keeping our options open allows us to adapt more easily to unforeseen life changes and shifts in our priorities. Housel also points out that true happiness often comes from growth and progress, not just from achieving fixed milestones. Many people believe that reaching a specific financial goal, like a certain salary or owning a luxury item, will bring lasting happiness. However, happiness is often more closely tied to the journey itself, the sense of progress and personal development. Therefore, financial planning should not only accommodate change, but also recognize that our ideal lifestyle and definition of success are likely to evolve over time. Chapter 15, Nothing's Free. The chapter explores the idea that everything valuable in life, including financial success, comes at a cost. Housel argues that this cost is often not immediately apparent or manifests in ways we don't anticipate. He emphasizes that understanding and accepting these hidden costs is essential for long-term financial well-being. He notes that the price of financial success is not always monetary. It can also involve stress, uncertainty, doubt, and the psychological discomfort of market volatility. Market returns, for example, are not free money. They come with the psychological cost of enduring market fluctuations and the occasional experience of losses. Many people desire the high returns that the stock market can offer, but they are unwilling to accept the inherent volatility that comes with it. Housel argues that the real fee for wealth accumulation is the ability to manage these psychological challenges and stay invested despite fear and uncertainty. Recognizing these costs can help us stick to our financial strategies. If we view market downturns as unexpected penalties, we are more likely to panic and sell at the worst possible time. However, if we understand these downturns as the inevitable cost of admission for long-term market participation, we are more likely to stay the course and benefit from the eventual recovery. Housel also points out that the costs of financial success are often intangible. Building wealth requires discipline, patience, and mental fortitude. It requires consistently saving a portion of our income, resisting the temptation to chase quick gains, and managing the fear and uncertainty that inevitably accompany financial decision-making. Many people desire the rewards of financial success, but they are unwilling to pay the price. Housel also notes that even happiness has a cost. While money can certainly alleviate some stressors, it can also introduce new ones, such as increased responsibility, pressure, and the anxiety of managing greater wealth. Therefore, it's essential to define success in a way that aligns with what we are truly willing to sacrifice. Chapter 16. You and Me. The chapter emphasizes the highly personal nature of financial decisions. Housel argues that there is no one-size-fits-all approach to money management. People's financial behaviors are shaped by their individual experiences, values, goals, and risk tolerances. Someone who grew up during a period of economic hardship might prioritize financial security above all else, while someone who experienced only prosperity might be more comfortable with high-risk investments. These differences mean that what seems like a logical financial decision to one person might appear completely irrational to another. Housel stresses that financial strategies should always be tailored to individual goals and values, not based on someone else's definition of success. He uses the analogy of investors and speculators in the same market. A long-term investor buying stocks for retirement might view a market crash as a buying opportunity, while a short-term trader seeking quick profits might see the same crash as a disaster. Both are operating with different goals and time horizons, and therefore, different strategies. Problems arise when individuals take financial advice from those who are playing a different game than they are. Housel cautions against blindly following financial advice without first understanding the underlying assumptions and goals of the person offering the advice. He emphasizes that many financial mistakes occur when people listen to advice that is not tailored to their specific needs and circumstances. Chapter 17. The Seduction of Pessimism. The chapter explores why pessimism is often more persuasive and believable than optimism, particularly in the realm of finance. Housel argues that people are naturally drawn to negative predictions because they often seem more realistic and urgent. While optimism can be dismissed as naive or wishful thinking, pessimism is often perceived as sophisticated and grounded in reality. Housel notes that bad news tends to grab our attention more effectively than good news. When someone predicts a market crash or an economic recession, people tend to take it seriously. Optimistic forecasts, on the other hand, are often met with skepticism. He also points out that humans are wired to fear losses more intensely than they enjoy gains, a phenomenon known as loss aversion. This makes negative financial news more impactful and easier to believe. Pessimism also benefits from the fact that it feels immediate, while optimism requires patience and a long-term perspective. Doomsayers gain attention because their predictions feel urgent and pressing, while the benefits of optimism often unfold slowly over time. Housel also suggests that fear sells. Media outlets, financial analysts, and even some investors often lean towards pessimism because fear-mongering generates clicks, views, and engagement. However, he notes that the vast majority of pessimistic predictions fail to materialize, while long-term progress tends to continue despite short-term setbacks. Housel concludes that while pessimism might be louder and more convincing in the short term, history demonstrates that long-term optimism is usually the more rational and ultimately more profitable approach. Understanding this bias can help us make more objective and less emotionally driven financial decisions. Chapter 18. When You'll Believe Anything. The chapter examines the powerful role of narratives in shaping our financial decisions. Housel argues that people don't make financial choices based purely on logic. They are often swayed by compelling stories, even if those stories lack concrete evidence. A well-crafted narrative, whether it's about a booming investment opportunity or an impending market crash, can drive market bubbles, panics, and investment trends, regardless of its factual basis. This chapter highlights the human tendency to seek simple explanations, especially during times of uncertainty. When faced with complex and unpredictable financial situations, people often crave certainty and are drawn to narratives that offer a sense of order and control, even if those narratives are based on speculation or misinformation. Housel also points out that confidence often trumps accuracy. A confident individual, even if demonstrably wrong, can be more persuasive than a cautious expert. Investors in the media often gravitate towards bold, extreme predictions, even if they are unlikely to be true, simply because they project an air of certainty. Furthermore, Housel argues that people struggle to accept the role of luck in financial outcomes. Instead of acknowledging the influence of chance, they often invent stories to explain why they deserved their success or why someone else's failure was inevitable. This tendency to rationalize luck can lead to distorted perceptions of risk and reward. Finally, Housel cautions against relying too heavily on historical data to predict the future. People tend to cherry-pick historical events to support their existing beliefs, ignoring the complexities and nuances of history. What worked in the past is not guaranteed to work again, and blindly following historical precedents can be misleading. Chapter 19. All Together Now. The chapter synthesizes the book's key lessons, emphasizing that money management is as much about psychology as it is about numbers. Housel reiterates that every financial decision is shaped by personal experiences. There is no single right way to manage money. What works for one person may not work for another. He stresses the importance of recognizing the role of both luck and risk in financial outcomes. Success in investing is never entirely a product of skill. Luck always plays a significant role. The challenge lies in discerning when luck has contributed to positive outcomes and when risk is lurking beneath the surface. Housel also reminds us of the power of compounding, emphasizing that small, consistent financial decisions over time can lead to massive results. Long-term patience is essential for building wealth. He also reiterates the distinction between getting wealthy and staying wealthy, noting that these require different mindsets and skill sets. Getting rich often involves risk-taking and bold action, while staying rich requires humility, caution, and a strong defense strategy. Housel advocates for simplicity in financial planning, arguing that being reasonable with money is more effective than striving for perfect rationality. Simple strategies such as consistently saving and avoiding unnecessary risks often yield better long-term results than complex and overly ambitious plans. He concludes by emphasizing that freedom is the ultimate financial goal. Money is not just about buying things, it's about gaining control over your time and choices. True wealth is measured by how much of your day you can spend doing what you want. Chapter 20. Confessions. The chapter offers a glimpse into Housel's personal financial philosophy. He prioritizes saving aggressively and living below his means, valuing financial independence more than maximizing wealth. His financial goals are deeply personal and centered around achieving peace of mind. He focuses on stability, security, and flexibility, rather than chasing the highest possible returns. Housel underscores the importance of defining enough and avoiding excessive risk. He acknowledges that no one, even financial experts, has all the answers, because money management is inherently emotional. The key is to find a strategy that works for you and stick with it. Postscript. A brief history of why the U.S. consumer thinks the way they do. The postscript explores how historical events have shaped the financial mindsets of American consumers. Housel argues that people's attitudes towards money are deeply influenced by the economic context in which they grew up. He traces the evolution of financial behaviors from the scarcity mindset of the Great Depression generation to the optimism of the post-World War II boom the fear instilled by the inflation of the 1960s, the 1970s, the normalized risk-taking of the 1980s and 1990s, the shattered confidence following the 2008 financial crisis, and the impact of technology and the internet on contemporary financial decision-making. He concludes that understanding these historical shifts helps explain why different generations have such varying perspectives on money, debt, risk, and investing. Our financial beliefs are not formed in a vacuum. They are a product of our experiences and the economic climate of our formative years. And that's a wrap on The Psychology of Money by Morgan Housel. If you found these insights valuable, please give this video a like and subscribe to the channel. I'd love to hear your biggest takeaways in the comments below. See you in the next one, with much love and gratitude.